Hey everybody, welcome back to the Economic Analyst channel. In this video, I'm going to go over the CPI report that just came out yesterday for May 2022. And much as I had surmised, we were going to see a retesting of the inflation peak that we saw in March 2022 with a rebound in the CPI. Much of this was driven by the rising cost of energy. So back in April, energy cost on a monthly basis dropped by 2.7%. I quickly realized that due to economic and geopolitical forces, this should not have happened, and it was more than likely because the Biden administration had intervened inside of the economy, released the strategic oil reserve, and depressed those oil and gas prices, which didn't catch on in March 22's final demand report. So it caused my final demand model to miss that distortion, that change. So this time I made sure that we were going to see the rebound in energy prices, and we largely did. Now, I did predict the energy prices were going to surge 6%. We only got 4%. However, what we did end up getting is new record peaks in food prices. So food prices jumped by a whopping 1.2% last month. That's an annualized basis of 14%, and it caused food price inflation to soar to all-time highs at 10% inflation. And we haven't seen those highs since the 1980s. Energy prices have soared by 35%, and just to keep in note, these energy prices have been elevated since 2021, when we were coming out of the pandemic and there was all the stimulus money that was being spent. There was the drive to travel once again and use airline fares, which consumes gas and oil. And after having record low energy prices in the 2020s because of destroyed oil production due to the lack of demand, we're seeing that rebound combined with monetary stimulus. Now, there's no doubt that the war in Ukraine is continuously putting upward pressure on energy prices, but to sit there and blame the whole thing on those foreign affairs, as in that's the only reason why energy prices are going up, I think is very misleading. That's coming out of the Biden administration. For one thing is that energy production here in terms of oil is down 10% on a month-over-month basis than where we were before the pandemic as of February 2020 when we reached all-time peaks. So the narrative that's coming out of the Biden administration is that we're producing more oil than ever before. No, we're not. And the only reason why we're exporting more oil is because Europe needs more oil and is demanding more oil because of the sanctions that have been placed on Russia. So there is some of that that's being put, that's putting pressure on energy prices. But again, as I've said before, the major component of price inflation is the money supply and money growth in wake of the same fixed volume of goods. And the detailed expenditure category kind of spells this out, because what we're seeing is inflation all across the board. So food, as I said before, food price inflation has jumped. Food at home has jumped by 1.4%. And you're seeing this from grains and rice and cereal and bread. You can see it in meats and poultries. You can see it in dairy and related products and so on and so forth. And let's go into more of the general category here. And there it kind of just spells it out. It's everywhere. It's everywhere and everything, okay? So one thing is that core price inflation is still remaining elevated after we got a temporary reprieve back in February and March. And the narrative that was being pushed out in investor markets is that we were going to see a drop in core price inflation even while food and energy stayed elevated, and that would drag inflation downward. And I'll go into this in just a few seconds about why that was a ridiculous narrative and it was devoid of reality. But even then, when we take a look at core inflation, we're seeing in food, clothing, we're seeing it in cars, both used and new. That was supposed to drop, and we're seeing a rebound in that. We're seeing it in transportation services. That one's not too surprising, because, once again, people are traveling. It's the summer. We're seeing it in medical care services. But the big component of core CPI, which represents 40%, over 40% of core CPI, is the shelter component. Now, I've warned about this in months past that we were going to see this rising shelter component. And the reason why we were going to see that is because we were seeing this delayed impact from rising housing prices. So back in 2020 and early parts of 2021, shelter price inflation actually dropped. Rental prices actually dropped as part of expenditures on the CPI. I think part of that had to do with the administrations under Trump and Biden during the COVID pandemic to suspend mandatory payments on rent as well as mortgages. You were able to defer those payments, but then in the latter half of 2021 that expired, and I probably mentioned to you that we were going to see the rebound in shelter. But even if we didn't, the rising housing prices, this record rising housing price inflation that we're seeing, is causing the shelter component to rise. And as a matter of fact, the shelter component's year-over-year inflation rate is now higher than what it was during 2007 and 2008, and it's not even going to stop peaking there. So I had done a while back, and I produced a video on this. I had done a little configuration of taking the Case-Shiller annual housing inflation and its impact on the CPI shelter inflation, the correlation between the two, and there's a delayed impact between it. So we're seeing this rising shelter component price inflation. Right now, the year over year is at 5.5%, which is, indicative of shelter price inflation rising up by 0.4 to 0.5%, but I'm afraid it's not going to stop there. We're probably going to see the peak reach somewhere between 6 and 7%. My regression analysis has it at 6.6%. So, in other words, the shelter component of the CPI is going to rise month over month on the average by about 0.6% per month. So that part of the CPI it's basically going to ensure that the CPI will rise from here on out by 0.2% per month or over 2% per year, just from 1/3 of the CPI, the shelter component. And again, this shelter component is not really indicative of reality, because ever since 1983, the CPI has been altered to take into account, as far as housing, owner's equivalent rent, which trends very closely with rental prices, yes, but it doesn't really reflect the expenses that homeowners have with mortgages and interest rates. Now, during the 2010s, record low interest rates on mortgages kept that mortgage expense lower. I know that's a shocker, but it kept that lower. But now that we're seeing these rising mortgage expenses for new homeowners, that's going to put upward pressure on that mortgage expense. And that's not really being captured in the shelter component here. So we're going to see that delayed impact effect on the CPI. So the CPI, even though it's being flattened by not capturing in that full measure of housing, it's going to stay higher for longer thanks to that. So even if we get a cooling down in price inflation, we're not going back to pre-pandemic rates of inflation. It will be systemically higher. My guess is that it will probably hover around, maybe around, I would say about 0.5% by my own little method. So even if food and energy started going down, if food price inflation were to chop in half to 0.5% per month, if energy price inflation cooled down to, say, 1.5% per month, and we just had a cooling down in the remaining core by 0.3% per month, that shelter component is still going to keep the CPI elevated at 0.5% rates, which will give you an annualized rate of 6%. Core CPI will cool down to about 4 to 5%, and I would think, and this is just my own little surmising, that is the best case scenario. Now, looking ahead here, already taking into account the high gas prices that we're seeing in June, and June's not over yet, we're looking at if the core price inflation trends the same, and it most likely will thanks to that shelter component. Remember, that shelter component is already going to give this core price inflation the 0.2% differential. So if we get that other 0.2% in the remaining components of core inflation, which includes transportation and the need to travel, and I think we're going to get that, along with another 1% jump in food, then we're looking at next month's inflation being almost as bad as this month's. And so if we do get that, 0.9% increase, we're going to see the annual inflation rate stay and remain at or near the peak at about 8.5%. Now, I don't have the final demand numbers for this month now, so the final demand model cannot confirm or deny that trend that's transpiring. But right now, just taking a look at the historical trends, that's pretty much most already baked into the cake there. It's looking like that price inflation, it might cool down. It might cool down to say 0.8, 0.7, and that might drop the annual inflation rates just slightly. But then if we still continue getting 0.9% month over month over month, and it's very likely that we will with energy, unless if we see that cooling down in energy prices or flattening out or peaking in energy and commodities, then we're still on track to see price inflation track over 10% by the end of this year, which has, basically been the narrative that I have been peddling. Of course, my narrative has been based more on data than some of the other narratives that we have been facing. And the major narrative that I'm using is the price formulation index. So in monetarist theory, there is the equation that money times velocity equals prices times quantity or nominal GDP. So, and I don't fully subscribe to that. Instead, I use a modified version that the money supply roughly equals prices times quantity of goods. But I also go one step further, and I don't hold to the monetarist or the Keynesian theory that even if that were true, that money can increase volumes of goods. More pieces of paper does not create more physical goods. Sometimes it can distort the production structure more to consumption to make it look that way, but in the end, you're destroying your production on the back end, and so what you get is a real shortage, and it's going to result in rising prices, even on a delayed effect, much like what we were seeing in COVID. So really, I expect that due to the elevated levels of the money supply, that we will more than likely start seeing the CPI increase and continue on an ascending rate, even if money has stalled out, as I have pointed out in a previous video. But I do want to talk about that right quick and talk about the money supply stalling out right quick. So in a previous video, I made a mention that the money supply had been flatlining in 2021, and I was puzzled as to why. I surmised that the Federal Reserve increasing the amount of overnight repurchase agreements sold back to the banks was draining bank reserves enough to depress that, but I was never satisfied with that as a full explanation. And instead, after doing a little bit of digging around, what I think is going on is that the General Treasury account, which is the bank account at the Federal Reserve that our federal government has been quietly building up money inside of their account, and it's reached a peak of $900 billion as of the end of April, which is the last data point that we've got for the money supply. Normally, what happens is that the General Treasury account will levy out bonds, and they will drain bank reserves to deposit the funds into the General Treasury account. Then they will spend the money, much like they did in 2021. This run-up here, this record run-up in 2020 was caused by the COVID stimulus funds, and then it was quietly paid out throughout the rest of 2021, which sort of had a delayed impact on prices here. But what we're seeing is a buildup in this money, and now it's being drawn down at record rates. So we're more than likely going to see the money supply increase again. This money supply increase is not being captured in this price formulation index yet. When it does, the price formulation index is going to increase yet further, and it will more than likely signal that the systemic inflation that we've been seeing in the mid parts of 2021 to 2022 will probably carry over into sometime into 2023. And if we start continuing an escalation because of high government spending, then we will see that money supply increase. And as I have been telling you and drilling you down, it's all about those basic fundamentals. More money in the wake of fixed volumes of goods will lead to higher prices. Now, the one last thing to note here, and then I'll wrap up, is that when it comes to the increase in the money supply, I don't think that M2 is a completely accurate assessment of the money supply. It's just a statistic. So to compensate, I use the total debt inside of our economy and index that with the money supply to create that price formulation index. That's another way that I differ from the monetarist in that. And it tends to hold true, and the relationship has held true all the way back to the 1970s. So with that, we're probably going to continuously see systemic inflation. And although the government spending on an absolute basis, so if I pull up government spending right quick, if we look at government spending on an absolute basis is starting to decline from the record peaks in 2020 and 2021, that's really only caused by more gridlock inside Washington, and and because of fiscal prudence on the state levels. It's still highly elevated, and it's 10% higher than what it was at the beginning of COVID on an annualized basis. But if we start seeing that continuous trend of dragging down declines in government spending, then that will put less pressure. On bank reserves and draining out those bank reserves, which will put downward pressure on money supply growth, which is why I've always been an advocate of cuts in government spending, so that way we get a real drop in that money supply growth that doesn't directly hit the private sector. Let me pull up one more data point, and then I'll wrap up, and that is the interest expense by our government, right quick, especially on the federal level. So right now, what we are seeing here is that the interest expense as part of the federal government is starting to quietly rise as interest rates are increasing on government bonds. We're going to see that continue, and the CBO has projected that by the end of 2023 or sometime in 2024, those interest payments are going to start threatening $700 billion. We were seeing this would be higher than what we have seen at any time in our nation's history. That $700, $800 billion in interest payments has to be drained out of bank reserves and could put upward pressure on that downward trend in government spending. So it would sort of create that floor in there. And that's the real threat, is that if the government continuously runs a deficit in debt and adds to it, those rising interest expenditures with Federal Reserve tightening monetary policy, raising interest rates, could actually still keep the money supply growth positive, and it could drag out the counterary forces of tight monetary policy to bring down those inflation rates. It's not that the tight monetary policy is needed, but it means that the Fed may have to raise rates even harder and tighten even harder than previous and squeeze that to bring down inflation back into equilibrium. So, and I'll go over some updates on precious metals. As you know, I've been very bullish on precious metals because I've been very pessimistic about the U.S. economy. And a lot of that has really spelled out right now. When we take a look at the Dow Jones and the rest of the stock indices, they have plummeted. So in the last 2 days, the Dow Jones has dropped by over 1,500 points because of the fears of inflation and then the confirmation on Friday morning. Year to date, the Dow Jones is down 14%, and it's practically the only stock indice that's not in bear market territory. The S&P is very close to bear market territory. Once it reaches that 20% from its peak at the beginning of this year, it will go down to bear market territory. The NASDAQ 100 is already in bear market territory. Bitcoin and cryptocurrencies have been in bear market territory, and they're going to continue to stay that way in bear market territory. And lastly, the Russell 2000, which is your small cap stocks, they have been in bear market territory, and we're going to continuously see that. They peaked back in November of 2011. So lots of excitement, but none of it good happening. And right now it's looking like we're going to see another hot inflation month for the month of June when that data comes out in July. So stay tuned for the next video that I create on this inflation, which will be the producer price index that will come out early next week. That should confirm probably the trend here that we're going to see an elevated inflation in the month of July. And as I've noted before, that will feed into this final demand model, which has a 95% accuracy rating of, forecasting and projecting that CPI plus or minus 0.5%. Guys, I thank you for watching this video. I hope that you enjoy the content. If you do, show me some support, like the video, subscribe to my channel, and click that notification bell so that you're notified anytime I upload a new video. Drop me a comment. Let me know about what you think about all of this. If there's anything that I've missed, is there a point that you think that I should cover? Let me know on that about this. I'm not perfect on this. I could be missing a couple of things that might impact our price inflation. So just, keep that in mind, and I'll talk to you next time.